Well, let me start by welcoming you to this first briefing on used EV tax credits. As the Recurrent team continues to meet with congressional staff and the Department of Treasury and their representatives and tax attorneys, we have planned subsequent briefings and chances to provide updates for you and for all of us along the way. And so think of this as the first of a series. While already so much has been written about the new side of the EV tax credit, we're getting a lot of questions from used car stakeholders. So this briefing is exclusively designed to cover the used EV tax credit and the requirements on both vehicles and their buyers. It maybe shouldn't be a surprise at this point that a 700-page document that is the Inflation Reduction Act can get a little bit confusing at times. Some parts lack clarity, others rely on systems that don't yet exist. But one thing is certainly clear, and that is that car dealerships will play a critical role in this process. So we've got about 25 minutes left. We have a ton to cover along the way. And so that means we should jump right in here. Your two key hosts for today are Liz Naiman and Scott Case. Liz is a mathematician and atmospheric scientist by training, and at Recurrent is heading up our regulatory affairs on tax credits. She would be a good person to talk to on this. Scott is the co-founder and CEO at Recurrent. You've likely heard from him at some point, whether at a conference or a podcast or a webinar. He has become a trusted guide on EV adoption in the United States. My name is Andrew Garberson. I'm Recurrent's head of marketing. So it's my job quickly here to share a little bit why Recurrent is following this so closely. Recurrent is the leading EV battery and range analytics company. We use insights from a community of 10,000 active EV drivers to create the most comprehensive range prediction and degradation models available. Two quick fun facts here. We recently surpassed 100 million recorded EV miles. And today, actually, we launched a new range score. This is designed for dealerships, wholesalers, and their customers. So with that context, how Recurrent fits into it, let me pass it to Liz to get started here on vehicle requirements.
Great. Thank you so much, Andy, and thank you so much for joining us here today. The way that we're going to do this is I'm going to handle the play-by-play, just the facts, and then I will pass it over to Scott to give the color commentary and our interpretation. So the first thing I want to get out of the way is the very good news. There's been a lot of concern from automakers and the industry about two particular requirements for the new EV tax credits, which are the battery sourcing requirements and the requirement that final assembly take place in North America. Neither one of those is in play for the used EV tax credit, so that's really good news. And it should greatly reduce complexity. There are a few criteria that do need to be met for a vehicle to be eligible for the used credits, and these are and. All of them have to be met. If any one of these requirements is not met, then the vehicle is not eligible. So the very easy one is that the battery has to be a minimum of 7 kilowatt hours. And that is an increase from 5 kilowatt hours in the old tax code, but pretty much means everything should qualify. The second requirement is that the used EV has to go through a dealer sale. And the code does specify that that would be a state licensed dealer or licensed through Puerto Rico or a Native American reservation. Next, we have that the model year has to be at least 2 years old. And the exact wording here is that the model year is at least 2 years earlier than the calendar year in which the taxpayer acquires such vehicle. So to clarify, that would mean that starting in 2023, 2021 model years are eligible. And once we get into 2024, 2022 model years will be eligible. Next, this is pretty simple. The sales price has to be under $25,000. And it still remains to be determined if that is inclusive or exclusive of sales tax. And I'll let Scott elaborate on that a bit. Finally, what is probably the most confusing and hotly debated vehicle requirement is this first transfer. And the text of this says that the sale has to be the first transfer since the date of the enactment to a qualified buyer other than the person with whom the original use of such vehicle commenced. Now that's a mouthful, and I'm going to let Scott try to disambiguate that for us.
First thing that's the big takeaway here is this must be sold by dealer requirement. That's a huge incentive for dealers over private party sales that doesn't exist for used combustion engine vehicles. So currently almost half of used cars are sold by private parties. And so with this one sentence requirement, it's not crazy that this could double the dealer share of used car sales over the next 10 years as EVs become 100% of the market over a long period of time. Now, we are tracking an open question on this, is like, does the definition of dealer exclude direct OEM used sales, which there are a couple of entities that are in that market. But that one we're sort of working on clarifying. But this is a big deal, I think, for the long term for the industry. Second, so the implication of sales price being less than 25,000. So today, that's only 17% of the used EVs that are at their retail price today. So we'd expect two things. One is this number, that percentage to bump up on January 1st as that actually becomes a meaningful cutoff. So you might imagine cars that were priced at 25,500 all of a sudden magically become 24,999. But then over time, that percentage will certainly grow as older EVs become more available. I think there's a particularly interesting opportunity here for low-end EVs. So I'm talking about like old Leafs, e-Golfs, Fiat 500Es that are often not being sold when they come up to auction because of concerns around battery health, which is like the reason we're around. But the other opportunity is around older plug-in electric vehicles. So the Prius Prime, the Chevy Volt with a V, this Ford C-Max Energy, all of those, in fact, really every car that has a plug-in plug as a hybrid meets that 7 kilowatt hour battery capacity size. So all of those are now in market for this. And that's something that the new EV tax credit is not addressing at all, these plug-in hybrids. So big opportunity on both those points. Okay, so the first transfer, this is the most complicated part of this program. So I'm gonna like talk through this, Liz and I are both gonna talk through this in a minute, but every VIN gets to use the EV credit once at most. And that's the first time it sells to a qualifying buyer. Now, in some cases, you might have a situation where the first time a car sells used, even though it is a qualifying EV and meets all the other requirements, but it could get sold to a non-qualifying buyer. And in that case, the VIN retains its ability to get the credit later when it's sold again. Now hold that thought for a couple of minutes as we dig into the qualifying buyer sort of language on the next section. But there's one easy takeaway that's important to know right away is that used EVs that were already sold used before January 1st of 2023 are all in play. So the board is clean as of January 1st, 2023, no matter what happened before, every EV at that point is potentially eligible. The last one, this 2-year-old model year requirement, which is one last impact, almost a side note to talk about here. This may be obvious, but the model year requirement means this is not going to be something that has any impact to what we've been calling and tracking as the new used EV market. A pretty substantial portion of the used market in the EV world over the past year or so is just current model year cars that are have a couple thousand miles on them and are being sold at a premium to the new MSRPs. This is developed due to long wait lists, and I'm sure some dealers on this call have been involved in that. So no change, there's no applicability for that market. Okay, back to you, Liz, for the play-by-play, part 2.
Great. So we talked a little bit about the vehicle requirements, and similarly, there are buyer requirements. And it works the same way. All of them need to be true in order for it to be an eligible sale. The first one, pretty straightforward. It has to be purchased by an individual for use and not for resale or commercial use. The bill adds in a pretty reasonable income cap to encourage adoption in a different demographic than sort of the original EV cohort. And these are half of the income caps for the new EV credits. It's $75,000 adjusted gross income for an individual filer, $150,000 for joint filers, and $112,500 for a head of household filer. The buyer has to have not received the same credit within 3 years, and that is trailing. So the text is they cannot have received the credit during the 3-year period ending on the date of the sale of such vehicle. And finally, the credit can be applied the credit is either applied as the lesser of 30% of the cost or up to $4,000. And an interesting thing that we're still investigating and we're speaking to some tax attorneys about is whether or not the tax credit will be able to be applied as a point of sale rebate starting in 2024. Now, that is something that the new cars will be able to receive their tax credit as a point of sale rebate. And it's still unclear what's going to go on with the used cars. So I'm going to pass that over to Scott for his commentary.
As I said before, a way of thinking about the used tax credit is that each VIN can get this once at most. It's sort of helpful. The way I think about it is every specific individual vehicle is either clean or it's been tainted by a previous used EV tax credit claim. The question is, like, has it, and therefore is it eligible for the next time around? So the straightforward case, like a quote normal, like nothing's normal, but like a straightforward case where things would all work is like car sold new to an owner. They claim the new credit or not, doesn't sort of really matter for this purpose. And then some period of time later, it sells used for under $25,000 to a qualified buyer. So that's an individual that is within these income limits. So that's the vanilla scenario. Now, everything else is going to be less straightforward than that. So here's some examples where it's not a straightforward process. So one is, let's say you have a vehicle that is brand new and it's leased for 3 years, so therefore owned by the bank or the leaseholder. And then after 3 years, it's sold to a fleet, not an individual buyer. And then 3 years after that, so 6 years in, it's now sold for its second time use to an individual buyer. That car is eligible for the used EV tax credit for the first time 6 years in. That's sort of a less straightforward process, but it would still sort of qualify. Second one, and this is a bit of an open question, but reading the text of the bill and sort of thinking about the spirit of what the bill is trying to accomplish, we have a situation where car is brand new, it's used for several years, and then it's sold to a secondary buyer who is above the income limits that was shared. Even if it sells for under $25,000, the buyer is not a qualifying buyer, and so now that VIN should still be in play. It hasn't been tainted yet for the next time it sells. So again, the implication is less straightforward path to it, but the second time it sells used, that VIN would be in play for that tax credit. Third one is a little bit of a weirder one, but if, let's say, again, car sells new, some years later it sells used for under $25,000 to a buyer who does meet the income qualifications, but that buyer doesn't claim the credit for whatever reason. In theory, that VIN is supposed to be at that point tainted because it was transferred to a qualified buyer. However, this is a bit of a tree falls in the forest situation. Like, if the government doesn't know, and specifically the IRS doesn't know that vehicle was sold, that it may still retain eligibility. So I think there's a question. This will come out to how the program is implemented. Okay, so assuming now you're trying to your business as a dealership is working with eligible vehicles, and then I think there's an interesting question about where's the market sweet spot for your customers. So Really, the sweet spot from an income perspective is going to be at the top end of these, towards the top end of these limits. So like for an individual buyer, the cutoff is the max income is $75,000 adjusted gross. You're going to be, for a variety of reasons, you're going to want to be looking mostly to sell between 50 to a buyer between 50 and 75,000. Within that realm, that buyer basically is going to be paying zero taxes the following year. Below that $50,000 number, they're probably not. They wouldn't have paid enough taxes to take advantage of the full $4,000. So they're not getting the whole benefit out of this. The other implication here on these income levels, actually, it's more on vehicle pricing levels, is $25,000 becomes a bit of a ceiling from the price point perspective, or a hard ceiling. But there's another price point to keep in mind that's $13,333, which is the minimum amount that a vehicle will be eligible to take the full tax credit. So below that, you would get a prorated addition, because it would be 30% of the purchase price would be less. Now, there are very few used EVs for sale in that $13,000 range, and this is more of a soft floor. But I think that there is something here, and I would sort of connect the dots around the monthly payment. For a $13,000 car with a $4,000 tax credit, especially if it's applied point of sale, you're now talking about the $9,000 car. So the monthly payment for a lease at that level, depending on interest rates, it's like $200 some dollars. That starts to line up with what you would have paid as a buyer in monthly monthly gasoline prices. So there's a kind of I think a marketing opportunity around that low price point as that becomes a larger and larger portion. All right, last thing, how this gets applied. So for Liz talked about, there's some open questions here. For 2023, it's very clear. So this is not a point of sale rebate, and this is going to be essentially a tax credit that buyers can take or need to take. They will file a form when they do their taxes, and that reduces their taxes paid. So in that sense, I think that the way we would imagine dealers will begin to market this is like, there's the base price of the car, it's $20,000 or whatever, and then here are as a dealer, our best beliefs about your 3-year likely fuel savings. So let's say that's $200 a month, and then here's the impact of the tax credit. Save $4,000 on that. So essentially, like, have it reflected as a 3-year total cost. And the neat thing is, to go back to that price point, $13,000 car with fuel savings and the tax credit works out to a total cost of ownership of nothing over the course of 3 years. So there's a nice sort of like moment there. And obviously, vehicles between 13 and 25, it's not going to be it's quite that flashy, but there's something there. In 2024, the language does indicate that there's a point of sale discount possibility. That implies a much different mechanism, and there are lots of questions about how that'll work. But we are in touch now with officials from the Department of Treasury who are starting to figure out about how this is going to work. So there is some time, obviously.
I realize it is a lot to unpack. Even in a short 25 minutes, we kind of loaded it up. That's why we will send you the slides and a link to this recording a little later this week. As Scott mentioned, we'll be doing a second briefing that is scheduled for October 13th. Just kind of the last bullet point here, we have started to design a free email course. It's EV Battery 101 for car dealerships. Feel free to sign up. You can use this short link leading up to the next briefing. But thank you again for joining. It was great to have you, and have a great week.